presenter is going to be Nic Pillow, who is a Ventures Director at Blackfinch, and he's going to tell us about all their exciting technology investments. Over to you, Nic.
Thank you, Brian. Yes, I'm going to give you the whistle-stop tour of the Blackfinch Spring VCT. I should say our own disclosure that we are FCA regulated. This is a high-risk investment, and what I say is not financial advice. Blackfinch itself is a multi-asset investment specialist led by Richard Cook, with a heritage going back over 30 years. We now have over 150 people across the UK and over £900 million assets under management. Our investments include renewable energy, property, even forestry now. And our solutions span from inheritance tax planning through to managed portfolio services. And the ventures part that I'm a director in covers our ventures EIS portfolios and the Blackfinch Spring VCT. Both of those invest in early stage technology companies. And we're particularly looking for companies with that sort of profile you can see there, where the companies are not just having the potential for good, solid linear growth, but that sort of explosive potential to generate orders of magnitude, growth. Of course, it's not always an easy journey, and we don't get involved at these very, very early stages over on the left. We are always looking for evidence that the founders are really capable of delivering and delivering at pace. We want evidence that there is commercial demand for the product or service that they are selling. And for the VCT, where we aim later than our EIS, we really want them to have built out that team and to know what it takes to get the customers to support them and deliver the revenue. And they need funding to do more of it, to scale up, to deliver that really exciting growth. It's never quite the smooth journey, and we do also then diversify over that stage. So some are slightly earlier, some slightly later, balancing out the risks and rewards across the portfolio. We also then diversify by sector, and we've now built 35 companies into the portfolio with a really wide range of sectors. We invest in technology, but of course that spans the whole economy these days. And you can see down in the left, we've got things like health and well-being tech, like helping elderly people at home. We've got companies powering the digital economy with, for example, advertising technology that doesn't involve personal data. And we've got more physical sectors like construction technology for new building projects, or even industrial processes. And all that diversification portfolio is designed around delivering dividends in two ways. First of all, regular dividends, and we target 5% a year regular dividends. We've now done that for 2 years running, having only launched 5 years ago. But also the potential for special dividends. And one of the nice things about the size we've got to is we've got that broad diversification, but if we get a nice juicy exit, the return from one investment, it still can provide, has the potential to provide, a meaningful special dividend to all the shareholders. Our minimum investment is £3,000, and we take then fees by default, initial promotion fee 2.5%, and then an ongoing annual management fee of 2%. And there will be a 20% performance fee, but only when we've reached a value of £1.30. And I'll come back to that in a moment. And there's the 5% discount buyback relating to Brian's point earlier. So the default initial promotion fee is 2.5%, because we also have an early bird offer, so the 1% discount on any applications up to 15th of December, and there's a 1% loyalty discount for any existing Blackfinch investors at any time on top of that early bird. Blackfinch has many teams to support the investments because of our group nature, so legal, compliance, technology, but the ventures investment team itself, there are 12 of us. And we have a really interesting mix of experience within the team. Several of us are startup founders, so Richard Harley, for example, on the left there, or in my case, my background was in working in technology companies, very high growth, successful companies, and the big enterprises like Nokia that bought them out. And then I went on to co-found and run my own startup before joining Blackfinch 6 years ago. We've also got technology experience. 3 of us have got engineering PhDs, which is very useful in the very more technical companies we look at. And of course, we have finance experience. So Kim here, for example, with a background in mergers and acquisitions. The other thing to say about the team is we work very collaboratively together. We're not going off finding our own investments. We're all working together to decide which are the right investments to take forward to add into the portfolio and how best to support the ones that are already in that portfolio. And in doing that, it's not just us. We also have a network of over 100 venture partners that we can draw on. And these are the people we add to the boards of our companies, people with real experience, whether that's in a particular type of business. So, for example, Geraldine Osman there, who is brilliant at marketing, or it's industry expertise. For example, Libby Chambers on the right, who is very much involved in the world of finance technology. She sits on the boards of Wise and of TSB, as well as one of our portfolio companies. So it's that all experience together, ours and the venture partners. How's it going? Well, I mentioned we launched 5 years ago. The first shares issued March 2020, just as the country descended into lockdown. And of course, as with any VCT, or should I say any successful VCT, there's been a bit of a J curve since then, because initially we haven't, we'd made no investments right at the start. We were incurring costs. The NAV per share came down to about 89 pence in 2022, but then the performance of the investment starts pulling that back, recouping it to back to the pound level. We started paying dividends, and now we're up to a total value assets of 64 million, with a NAV per share plus the dividends. That value returned to clients of 106.7 pence. And this is the reason it's a great time to get in now, because remember I mentioned that our performance fee hurdle is £1.30. There's still a good 23 pence to get up before we start taking any of the increase in value that is going to shareholders and to investors. Just to show that slightly more accurately, quarter by quarter, that's the actual curve we've been on. And you can see in the top right there, that darker color, those are the dividends we've paid out, where we're returning more value to investors. And as I say, we've now paid 2 full years of 5% dividends a year, and it's very much our target to maintain those regular dividends alongside the potential for special dividends. Just to give you a couple of examples, because it is all about the companies in the portfolio ultimately. If you go abroad, get one of these. It's a currency card. It's a travel debit card that saves you all the extortionate bank charges and marked up exchange rates that you get with the high street banks. What's special about this one is that you don't need to move money into a separate account in order to pay. It just links directly to your own bank account, in my case, Barclays, and it is exactly like paying from my own account, but without all those charges. It is so simple. The really exciting thing from an investment point of view, though, is that same technology linking into any bank means they're able to offer loyalty debit cards. And the first major one they launched was with Hilton Hotels, so if you have the Hilton Honors loyalty debit card, that is powered by currency, and it's driven a lot of interest from other major multinationals who want their own loyalty debit card. And then Spaceflux, our latest investment, which is monitoring what's going up in space. It's amazing technology, such precision to be able to track things as small as 2.5 centimeters across, whizzing around the Earth at unbelievable speeds. And it's getting really important because it is getting congested up there. More and more satellites going up, a lot of debris, and commercial satellite operators want to know what's going on. Governments really want to know what's going on up there, because there's a lot of aggressive maneuvering going on amongst certain satellites up there. So increasing demand. Spaceflux is the company keeping an eye on what's going on up in space. So that is the Blackfinch Spring VCT with our expert team, including that mix of technology, finance, and startup experience, supplemented by our value add venture partners. And then the the regular dividends, the 5%, plus that nice size where we've got good diversification, but still the potential, for some, really interesting special dividends. And of course, that high hurdle for the performance fee, where actually there's still quite a lot of value that you can get as investors before we start taking our performance fee from that. That's it. Thank you very much.
Thank you for that, Nic. Very, very informative. We've got a couple of questions that have come in. The first one I'll pose to you is the NAV return excluding the dividend return?
So the NAV return that I showed that's the NAV total return. You mean on this slide?
It must be related to that slide, correct? Yeah.
So dividends are part of that, yes. So that would be, what's the the value of the NAV at the starting point to what's the value of the NAV at the end of the period plus the dividends paid within that period.
And it's termed NAV total return, isn't it, with the dividends backed into there? Perfect. Cool. That answered that one. And then I think you've mentioned, obviously, the VCT is relatively new, 5 years. You've had it. I guess, what was the thought process for Blackfinch, I guess, to add it to your product offering, given you had some other products there already? And also, how easy or tough has it been to grow to the size you are today of the 64 million?
Two parts to that. So first of all, the reason we added it was because we were being asked for it. We provided the EIS product first, and it was a natural extension to be able to do that from a client point of view, but also as a vehicle then providing some follow-on funding for the well-performing EIS companies. It was very hard to get off the ground, and I'm sure everybody else would tell you the same. That first 3 million that we got was very hard won. I would say since we started paying dividends, it's become much easier to grow, and we've been very pleased with the growth that we've seen, and 24 million brought in last year. So now that it's got going, it's going very well.
Perfect. Good to hear. And then lastly, it's been a tough environment over the last few years, as you've mentioned, with regards to exits. And this isn't just for VCTs, this is just for companies as a whole. Has that made you pivot at all in the way you think about selecting companies or the investment strategy?
We always look long term in investments. We've got to sort of try and predict what's going to be happening. And so we've always got to adapt what we are doing. Looking at what's actually going to be successful, not right now, but what's going to be successful in 5 or more years' time. So yes, it has been hard in terms of exits, and from that point of view, we've encouraged some companies that have had approaches to hold on because we think they get better value further down the line. But I don't think that's materially changed the fact that we're always just trying to look ahead. We're adapting anyway to what is likely to give the best returns at the point of the exit, as I say, in 5 or more years' time.
Thank you very much, everybody, and we'll see you next time.